When it comes to mortgage lending, almost every decision a homeowner or a homebuyer needs to make comes with both pros and cons. And in many cases, there's no definite right or wrong answer. I find the topic of whether or not to have an escrow or an impound account for property taxes and homeowners insurance is one of those decisions our clients fear getting wrong. So today, let's explain how impound accounts work and look on their bright side to see if they're a good fit for you. Hey guys, welcome to Rockin' Real Estate. I'm Rob Spinosa, residential mortgage loan originator. If you're a home buyer, a homeowner, or a real estate professional looking for home finance tips, tricks, and your favorite guitar licks, I've got your backstage pass to better understanding the mortgage business. All right, so let's start with an explanation of how impounds work. But before we do, let's acknowledge that for this discussion, escrows, the account, are different from escrow, the company that handles your closing in certain states, and that both escrows and impounds, when referring to the account, are synonyms. We'll interchange these two terms throughout our discussion, but they mean the same thing. Let's say you're renting right now. When you become a homeowner, your housing payment will be comprised of a mortgage payment, usually principal and interest, as well as real estate or property taxes and homeowners insurance. You may also have homeowners association dues, also known as HOA dues, and some form of private mortgage insurance or PMI. But for now, let's focus on the big four: principal, interest, taxes, and insurance, known in industry speak as PITI. Let's also be sure not to confuse your total monthly housing payment, PITI, with how you pay your PITI. That's where escrows get interesting. While your mortgage payment is due every month on the 1st, for everyone, everywhere, your property taxes may be due in installments at various points in the year, and in the case of homeowners insurance, may be due as an annual premium. Taxes and insurance will have ongoing due dates that are not necessarily required to be collected on a monthly basis, like your principal and interest. But the purpose of an escrow account is for your mortgage servicer, the company to whom you send your payments, to collect 1/12 of your property taxes and insurance along with your mortgage payment. Then, whenever the tax and insurance bills come due, your servicer will pay them without your intervention. And this brings up a really important aspect of impound accounts. Even though you pay your servicer a portion of your tax and insurance bills each month, your servicer in turn does not pay these bills monthly and instead pays them when they come due. Once configured, most borrowers enjoy the set and forget nature of impounds. After a while, you get used to making your monthly payment, and then you don't need to worry about paying your property taxes and your homeowner's insurance separately. I guess you could say escrows are like a budgeting tool for the homeowner. But you could say that a downside to escrows is that you're making a larger payment every month, whereas the borrower who waives escrows is paying only principal and interest. Another aspect of impounds that can be viewed as undesirable is the creation of the account itself. When you purchase a home and choose to have a loan with an impound account, or when you refinance and add impounds where they didn't exist before, the closing agent will reserve several months of taxes and insurance into the escrow account at close, and this can easily add several $1,000s to your settlement. The reason for this involves a somewhat complicated calculation, so get in touch if you have any questions and we'll be happy to help you with it directly. Okay, so now on to the choice, to impound or not to impound. First off, some loan types just require impounds. Government loans, for example, FHA loans, VA loans require impounds in every case. Some non-QM loans also require impounds. And then, depending on the state in which the finance property exists, some loans at higher loan-to-values or LTVs might require impounds as well. In these cases, you just won't have a choice. Your lender will require that an impound account is set up. But for most conventional and jumbo loans and LTVs under 80%, you may have an option to waive escrows and pay your property taxes and insurance on your own. So ask us or your loan professional if you need more detail. If you have any questions about impounds or escrows or any other aspect of the home loan process that will get you the financing you need, don't hesitate to get in touch at any of the links below or by calling us directly at 415-367-5959. And if you found today's video helpful, please click on the like and subscribe buttons below and we'll keep the hits coming.